Hey, everybody. I hope you're having a great morning so far. It is just turning lunch hour on April 8th, and we've got a little bit of a bounce happening here today. Maybe not that surprising after really what was one of the most incredible drubbings I've seen in many, many years. Really, I guess we have to go back to COVID since we saw a serious sell-off somewhat like that. Very, very big, pushed the VIX up to around 60 in the pre-market. I think we got into the low 50s after the open, but we're getting a little bit of a bounce here, almost a 10% bounce, maybe 7, 8% bounce at this point, towards that 9 EMA. So I think we can probably tag that 9 EMA over the next, maybe today or perhaps tomorrow. But tomorrow, of course, is a very big day with a lot of news, the April 9th day that Trump's been talking about. So we'll have to see how that goes. But really, there's probably rooms we could end up sort of landing somewhere between this 9 EMA and the 20-day as an area where you could maybe get a little bit bearish, maybe add some hedges, maybe add some sort of credit spreads that might work. And I'm going to show you guys one of those in the next video. But today, I just want to talk a little bit about the environment. We can see that it's still very fearful. So we've got a bounce happening, but the term structure, the VIX term structure, still very backwardated, which is, essentially means that those front futures are higher than any subsequent future. And really, we're backwardated all the way to November. So you don't see that unless they're pretty good fear levels out there. And of course, the VIX is up around 40. We hit 60 pre-market yesterday, just about. We dropped back by the open. We pulled back down into the 30s when we had that fake news come out about some tariffs being delayed for much of the world. And then we basically, dropped back, ran back up into the 50s. And here we are pulling back today on a little bit of a relaxation of fear levels. We can see one of the areas to watch is going to be rate vol, credit vol is going to be important. So you can see the move index here. This is rate vol. So we hit this very high levels, higher than we saw last year when there was quite a bit of rate uncertainty going into the election. We hit very high levels again, very much parabolic chart here. We've pulled back just a little bit here, but far from being having been solved. The VIX 9-day to the VIX is an area we see this. It's a gauge that I like to look at. We got up into the 150s yesterday, which is something you don't see very often at all. That front 9-day VIX really soaring past the 30-day. We have pulled back a little bit down to the low 110s, and we're back to 128. So I'd say anywhere around 130 or above, we're still in very uncertain territory from a fear perspective. Here's your high yield HYG, big pullback yesterday and a little bit of a bounce today. So this is one thing we're going to have to watch, right? If things get a little bit more uncertain in the rate area in credit, we see those credit spreads blow out a little bit more, then that's a big problem, right? That's something that's going to seep into volatility, into the VIX and equities, et cetera. So that's an area where we want to make sure we're not starting to see some problems, some blow-ups in the sort of financial plumbing area of things. That could be something that takes the sell-off to a new level. So sector watch today, we can see that of course year to date down almost 14%. So we were down quite a bit more than that as of Sunday night, and we've bounced back a little bit. Information technology, of course, taking the brunt of it this year. Energy was really kind of a top performer, and that's really pulled back as oil's come down. The prospect of a perhaps global slowdown, recession is going to probably not be great for oil and these companies. Now, these are stocks that look interesting. They're very big. I think we could get into a market where maybe you want to be looking at sort of more, higher dividend names, a little bit more defensive, a little bit more kind of yielding type stuff as markets try to figure things out, as this tariff stuff sort of plays out, which really is going to take a long time unless they really dial back some of the damage that's been done. So it may be that people kind of continue to eye consumer staples, some healthcare, utilities, and even a little bit of real estate. If we start getting lower rates, I'm starting to see some things act a little better there. Not sure I love the home builders so much. but some of the picks and shovels, kind of intermediate middlemen type companies like a Rocket, kind of look a little bit interesting to me, maybe a Zillow. So if we do get rates coming down and a little bit of unfreezing in the real estate market, right, have that secondary resale market unfreeze where it's been basically paralyzed for years because everybody locked in those low rates, nobody wants to sell. That if that starts to lubricate that secondary market, that resale market, then there could be some interesting opportunities in there. First of all, I want to show you fixed strike vol. So what that means is basically you're looking at implied volatility per actual strike. So what happens with the VIX is sometimes the market will just kind of ride up the curve as the market sells off. Everyone says, oh, look, everyone's reaching for protection. The VIX is going up. It's not really going up. The market is simply kind of moving into a higher skew level, a higher implied level on that skew curve, right? So there's a sort of shape to that curve. Sometimes, in the index, it's more like a smirk, and some stocks, it's like a smile. But when the market moves down into that, it just kind of, the VIX goes up. But when people are truly fearful, you're going to see fixed strike vol push up. So that it's not just riding down that curve, it is people clamoring for protection. What we're seeing today is the opposite of that. We're seeing things relax on the fixed strike side of things. That is a positive, but I'd say you probably shouldn't read too much into that because we've really come off a very, very elevated fear level. So it's natural that this is going to pull back a little bit. So under normal circumstances in slightly fearful markets, I would say this is a very, very good sign. We saw that around 5,500 before the big bounce to 5,800. We saw that fixed strike vol come down. At this stage, I don't think there's really a ton to read into it. It's just a little pullback in the extreme levels that we saw yesterday morning. So I think, all in all, the problems still remain. I think we're getting a bit of a technical bounce here. I think we could probably get up towards that 9 EMA, maybe even somewhere between the 9 and this 20 SMA here, where the market may have a little trouble. We can see it come back into this area where there was a little bit of activity. You can almost create a little channel in here. And of course, that 20 is going to offer some resistance. And then we're gonna basically have a little trouble getting through this supply zone here. So I think that kind of gives you an idea of what's happening out there from a skew perspective. Now we'll look at the term structure, which is all that is basically where are options priced through time, right? So different expiries. All these are different expiries as we go forward through time. Here's May, June over here, etc. So we can see that very, very fearful at the front part of the curve. So not very meaningful when you're looking at, an expiry that is today. This is today's expiry. Doesn't really matter too much. So we can see that it comes down, but this whole curve was basically, this term structure was up higher, and it's come in a little bit today as we see that VIX come down and fear levels come down a little bit. Here's your skew. It's relaxed a little bit as we talked about in the fixed strike matrix. We can see that the skew has probably relaxed a little bit, has sort of flattened just a slight bit to the downside, but clearly we're very high above the shaded area, which is where what we would call more normalized areas for skew. This is the 10th percentile at the bottom of the shadow, and this is the 90th percentile at the top of the shadow. So think of this as a kind of normalized range of where skew can be. And again, skew is just sort of, here we are currently at 515. Skew just kind of talks about, well, everyone talks about at the money implied volatility. Skew kind of describes, well, where are the out of the money puts and where are the out of the money calls, and how do they relate to each other? You can separate the two. You can just talk about put skew and you can talk about call skew. And I think that's a good way to do it because you really want to know what's happening on both sides. Otherwise, if it's a blend of the two, then you don't necessarily know what's happening. If skew comes down, if a blend of skew comes down, is it coming down because puts are coming down or because calls are going up a little bit? Now, puts will probably, drive the bus a little bit more. That's where a lot of the vol is. That's where a lot of the kind of, tail wagging happens. But it's good. I think it's good to separate the two. And that's what also gives us opportunity as well, right? We talked about the MSTR skew, looks very interesting to the upside, very, very flat. So there may be opportunity there if this market kind of stabilizes, if Bitcoin stabilizes. So skew isolated from call to put can give you some interesting ideas. So that's basically what I'm looking at here. Clearly, the sort of end result here is that fear levels are still very, very high, and as they should be. We're going into a lot of Fed speakers this week. We're going into a big event tomorrow. A lot of damage has been done, and the longer this goes on for, the more serious it gets in terms of its impact to the world economy, to growth, and inflation. We'll have to see how that works out. Tariffs are inflationary. Torsten Slok talked about how we're probably looking at about 1.5 points of inflation just from the tariffs, but growth is going to dial back some of that perhaps if we go into a difficult period growth-wise, then that can be deflationary as well. So, but we could be in a bit of a pickle because uh, the tariff impact on inflation, as well as the sort of secondary effects on supply chains, right? There are going to be companies that say, "Well, I'm not going to order these products." We had Land Rover come out and say, "Well, we're not even going to sell cars in the U.S. At this point with the way things are." Maybe the Amazons of the world are going to say, "Well, we're not ordering this stuff from China because this isn't going to sell, or this doesn't make sense." So we're potentially facing a whole bunch of sort of supply type disruptions, not just demand destruction, but kind of something akin to a supply destruction from this sort of people reevaluating what they're going to sort of import, um, and so on and so forth. So very interesting situation, very fluid, and we'll have to see how things play out. But for now, things are very fearful, a little bit less so than yesterday morning, where we were sort of staring into the abyss. But without a doubt, we are nowhere near out of the woods here. So in my next video, I'm going to talk about some of the things we can do, some hedges, some ways to generate a little bit of income. So we'll see you in that one.